Ladies and gentlemen, welcome to our investing podcast. Today we have Lars Kroijer, a former hedge fund manager and a famous author of the book Investing Demystified. Hello Lars, how are you?
Good. Thanks for having me on.
I know that you don't have a lot of time, so let me start with the first question. In one of your videos, you mentioned that three mistakes investors often make are the following. Investors think they have an edge to beat the markets. Investors concentrate their assets in their home country, and they struggle to understand the long-term implications of what people do with their savings. And you said the following: we're all guilty of being programmed that equity markets are something we should invest in for the long run, because it would give us superior returns to more stable bond returns or cash in the bank. I think that's a dangerous thing. I think that we cannot assume that the equity markets are going to go up over the very long run. It could be that over the next generation, equity markets are down 80-90%. And this is shocking, was shocking for me to hear. So given the bad demographics and low growth for most countries, how probable do you see such a scenario of Japanification for global equity markets? And how can we overcome tail risk since all correlations jump to 1 during bear markets?
Yeah. Well, so first of all, I think it's important to understand that I'm not making predictions about what happens in the future. I think then I would be as guilty of looking into the future as I sometimes accuse others of being. I'm simply saying, well, what can happen? And it's a very, very dangerous assumption that equity markets will always go up. Now, suppose for a second it is the case. Why would you ever invest in government bonds that generate zero real return? I mean, if you can invest in equities and generate a higher return, and that's always the case, why would you ever buy U.S. Treasuries? That get you zero return even in the medium term. Now, that doesn't. So making that prediction, I'm not saying one way or another. I'm just saying that it's up to the individual to understand the kind of risk they can tolerate, and then invest accordingly. So if you can afford in your investment portfolio a fair amount of risk, well, you can afford to invest in equity markets and have things not work out for you once in a while. To put things in perspective, when I went to university a long time ago, Japan was like everything everyone was talking about. It's sort of the internet of the time. And since then, the market went down 80% in Japan and stayed down 80% for about 20-25 years. And so from the perspective of most people's investment horizon, that was what they were looking at. So it wasn't that it always came back. In fact, it's still not come back.
Yeah, from your book, Investing Demystified, everything looked so simple, so easy for a retail investor. You say you just set up your risk profile, which is your risk tolerance, maybe your age, and then you decide how much in equities, how much in bonds. And for the equity part, the simplest thing you can do is to buy the cheapest, broadly diversified global index tracker you can find. Either it's from MSCI or FTSE, doesn't matter. While for the bonds allocation, you take your local government bonds, which have to be investment grade to match your investment horizon. You don't get any currency risk, and you have the tax benefits to it. So again, very simple. Now, if you were living in Romania, that could be a little issue because based on Standard & Poor's and Moody's ratings, we have the lowest investment grade status, BBB minus, with negative outlook. We're still investment grade. We have the highest yield in Europe, I think 2% at euros for 5-year term treasuries. So I'm not sure if we should follow that strategy as a Romanian investor.
Right. Yeah, let me try to explain that. So what I propose to most people is that you can create quite a simple and very, very theoretically and practically robust investment portfolio with just two products, two investments. One is an investment in equities, which, as you said, should be the broadest, cheapest, most tax efficient equity exposure you can find, which is typically a global index tracker from Vanguard, from BlackRock, whatever. They're all competing. They're all very cheap. Then you say, well, so what if for a second your investment should not just be equities? What if your risk profile is such that you shouldn't just invest in equities? What should you combine this equity exposure with? And here's where I'm saying you should, if you want to still create a very simple investment product, you should combine it with the lowest risk thing you can get your hands on. Now, what is that? Right? So what's the lowest risk product? Well, it's if you're an investor in the US or in the UK or Germany or places like that, it's the local government bond. It's better than cash in the bank. It's better than money under your pillow. It's better than gold, which is actually quite volatile. And you're not trying to make money from this. You're just trying to not lose money. The place you make money is your actually investment. Now, so what happens if you live in a country like Romania where there is no highly rated government bond? Then you're essentially faced with a choice. You can either take this sort of low risk investment and make it a combination of several things, such as risky local government bonds, risky cash in the bank, but also you would take credit risk, right, with the Romanian government, or you can invest in, say, German government bonds, U.S. government bonds, but you take risk with the foreign currency exposure. So in other words, that can appreciate or depreciate, which is hard to predict. So in a sense, the bucket of the lowest risk asset, I think, very often ends up being a combination of several things. You might, and also the money under your pillow, yeah, it might feel safe, but sometimes people, at least historically, literally do that, sometimes with gold. But certainly in terms of currency, it's far from low risk to have liquid cash lying around, and the value of it would be eroded by inflation. So I wouldn't recommend doing that.
By the way, besides equities, do you recommend another inflation hedge for a retail investor?
Is what, sir? Is equities an investment? Yeah, I mean,
No.
I mean,
I say besides equities, if you should have another inflation hedge in our portfolio.
Well, you can. I mean, in a lot of countries, you can actually buy government bonds that are where the return is adjusted by the consumer price index. So that's an inflation hedge. And if you're worried about inflation, I mean, very often keep in mind, the expected future inflation is priced into the value of the bonds, right? So let's say you're expecting to receive $100 in 5 years, literally $100. Then what's the value of that today? Well, it's a measure of the credit risk and interest rate and inflation expectation, right? And so let's say compare that to receiving 100 bolivar, the Venezuelan currency, and let's just for a second argue that there would be the same credit risk. Well, the inflation risk there, expected inflation, is much, much higher. So you would pay far less for that now. In other words, it's already priced into the value of the bond. Of course, it can change, and then the price of the bond would change, which is why some governments started offering government bonds that adjust for the consumer price index.
Like
so if you're worried about inflation, I'd strongly encourage you to look at that. I don't know if Romania has bonds like that. I wouldn't be surprised if they did.
By the way, Mr. Lars, if you buy a global index tracker, you say you are globally diversified, and that's true for the equities part, but it only has access to market beta, and there are several sources of beta. We have size, value, momentum, quality, low beta, and so on and so forth. So basically, as retail investors, could you create a better risk-adjusted return portfolio for combining, diversifying these systematic independence risk factors somehow in a long-only multi-factor approach, because we don't have access to long-short factor exposure?
I think the reason I don't think you should is you're very, keep in mind, the overriding theme is here. How do you take something that is as complex and convoluted and filled with people that want to charge you fees and make it something so simple that most people should be able to do it themselves. And this is why I keep coming back to, you got to keep it so simple that there's no question about all this other stuff. And once you start introducing value, growth, emerging markets, all these factors, then it gets very complicated. The next thing you know, there's some guy wearing a suit who charges you a lot for telling you what to do. So stay away from that. Now, so that's the sort of, just don't. The theoretical answer is why you shouldn't is because if you think about, well, what is the weighting of the global index? And we can talk about, there are some issues around the global index, but it's never perfect. Is, let's say you have two stocks. One is Apple, and Apple is worth 100, and one is France Telecom, the French random name, and that's worth 10. So how much should you own of those two? Well, the world is telling you that Apple is worth 100 and France Telecom is worth 10. So you should own 10 times as much Apple as you should own France Telecom. Now, why is that? That's because that's saying indirectly that each dollar invested in the market is equally clever, equally well informed, which is consistent with this premise that you can't beat the market. So once you start introducing all these factors, you're very quickly moving towards saying, if you say value stocks will do better, well, you might be right, but it's a very, very bold statement. You're essentially saying that the $100 trillion plus capital markets and equities is wrong. They have wrongly valued value stocks, right? And yeah, even if you're right, I mean, that's a very bold thing to claim.
Yeah, but still, Jeremy Gantam from GMO says that the US stocks are in bubble territory. He recommends zero exposure to them. And also, I remember you said in a podcast that something you can do without massively contradicting the idea that you cannot beat the markets would be to invest 50% in emerging markets and 50% in developed markets. Given the practical ways we have for investing in emerging markets, what do you choose between a low-cost market?
Well, so let me just address the first, which is someone saying that the markets are expensive and you should do zero. Well, how does he know? If I had $1 for every time someone told me they know which way markets are going to go, that's a very, very common thing. In fact, anyone who works at a big bank or works at a big institution gets paid to make statements like that, and it's to justify why people should pay them a lot of fees. No one gets paid fees if you go and buy a broad and cheap index tracker. You get paid fees if you make bold statements that later may or may not turn out to be true, because you're helping people make an allocation away from it. So it's it's the kind of statements, there'll be someone saying something like that every day, very often contradictory. Someone will say, U.S. markets are undervalued. They're going to grow 50% this year. You're going to have someone say that. You're going to have someone say they're going to decline 50%. Now, if you knew who was right and who was wrong, yeah, by all means, go make the right decisions. But the premise, again, is you don't know, because you don't know better than the $100 trillion plus financial markets that have already made these allocations. So all the people that wake up today in the U.S. and buying stocks in all these high-tech growth companies, you're really saying you're all wrong. You're all wrong. I'm sitting here and I know better than you that these stocks are overvalued. Now, you might be right, but it's a very, very bold statement. And I'm saying don't do that. Now, the reason I said you can invest in emerging markets index tracker, yeah, I don't think you have to, but if you want to, it's not, global stocks correlate pretty highly, particularly in a drawdown. Now, one of the things that happens in a global index is that there's a huge exposure to U.S. stocks. So the U.S. stock market is a disproportionate part of a global index. That makes some people uncomfortable, and I can see why. So the reason it makes people uncomfortable is they say, well, the U.S. economy is roughly 20% of the global economy. The U.S. equity markets is more than 50% of a lot of these trackers. How can that be? Now, there's a short and a long answer. The short answer is that's not necessarily inconsistent because, the sort of efficiency of global capital markets means that they would shift money away from those markets if it wasn't good value. But I'm saying, look, if you feel better about allocating according to GDP or according to some other measure, it's not a huge separation from what I'm saying, because you're still buying very broad and very cheap index products. Just don't get too cute, because you are making a statement. If you're buying an index of emerging markets for $50 and then $50 of the global trackers, you are saying indirectly that I think emerging market stocks are going to outperform. Now, will they? I don't know, but that's what you're saying, because you're that's not what the global capital markets is.
Yeah, but if you were to, let's say, diversify away from US equities and go a little bit more into emerging markets, would you choose a market cap weighted index fund which also is concentrated very much on China, or perhaps a multi-factor long only smart beta ETF which has less exposure on China, a little bit diversification on factors but only in long only format, so you have to make some regressions and see
It sounds
how
like
much.
you have a vested interest in it. No, I wouldn't. I'll tell you why I don't buy any of these smart beta products. I don't like them. A couple of reasons. First of all, let's just say they charge 0.25% more per year. Okay. The overlap between market cap weighted indices and all these smart indices is typically 2/3 or 50%, i.e. they own a lot of the same stuff, but they charge more. So the de facto extra charge for the difference is much greater than the 0.25%. Okay, so that's one. So you pay sometimes up to 1% more implicitly for the difference. The second point is, again, if the market cap weighting is such that they're saying Apple is worth 100 and something else is worth 10, and you're saying, well, I don't believe that weighting, you're really saying they're wrong. You're saying all these investors are wrong. And I'm saying, if you're right, well, good luck to you. Go make a lot of money. In fact, here's an arbitrage trade for you. Go do whatever you were going to do. Take all your factors, whatever you want. And then against that, short the market cap weighted index. And you should make money. In fact, you should make money without taking meaningful market risk. And then gear that to all heaven and you'll get really rich if you're right. Now, the reason you can't do that with a market cap weighted index is because you cannot reallocate dollars more efficiently than what the market has already done, unless you think you can beat the market. The whole premise is most people cannot. Now, I know there are a lot of people out there that think they can, and maybe some of them are right. That's not relevant to most people. My mom can't beat the market. She shouldn't spend money and time trying. That's what this message is mainly aimed at, is those people. They shouldn't try it, don't spend the time.
Okay. In periods of increased equity market volatility, would you overinvest in equities during drawdowns or just rebalance your portfolio based on your static asset allocation? In Romania, there are financial planners who recommend that if you are a rather defensive investor who has a larger cash pile on the sidelines, you should buy more on correction at each -5% price decline. Some even consider using martingale strategy, like dumping money if stocks correct, which is insane.
Yeah. Well, I think you just answered your own question there. I think there's sometimes reminds me of people that go to casino. Suppose you go to the casino and you put money on red and black comes up, you lose your money. Well, then you put double on red. And eventually red will come up and you will make money, right? That's a certain strategy to make money. Except if you ever get stopped out. Except if black comes up enough times in a row that you basically can't afford to keep playing, and then you're bankrupt. Now, that's a little bit, perhaps I'm being cynical, but that's a little bit the argument those people are saying, that when markets go down, you just keep doubling up, and eventually it'll come back and you'll make money. I think the greater issue there is it's very likely in a major drawdown that it has real implications for your non-investment life. And you have to understand that. So what else happened in your life during this drawdown? Maybe nothing. Maybe you lost your job because it's a global recession. Maybe the kind of education you have is all of a sudden less valuable because of the kind of if you were working in finance and 2008 happened, not only did you lose money and maybe lose your job, also your future job prospects got worse because of that, all for the same reason. So you got to think a little bit about what that does to your risk tolerance. Like maybe your house went down in value, maybe your local currency depreciated massively. So it's not that straightforward. I think that's more an area where you really could benefit from a financial planner. Don't hire a financial planner to tell you markets are going to go up or down. They don't know. If they knew that, they wouldn't be talking to you. They'd be out being the next George Soros. They don't know. Start with the premise they can't beat the market. They can't pick individual stocks. But they can help you think about your personal risks, like how much risk you should take at various points in your life. They can help you by optimizing your taxes. They can help you by being someone that you can lean on when you're not. And that's valuable. And that's why you should have a planner for those things. But don't pay someone a lot of money to outperform the markets. They can't. It's very, very unlikely. By the way, can you imagine I sat here and I had a magic trick on knowing which stocks were going to go up and which stocks were going to go down. And I would only charge you a little bit of money to tell you that. Doesn't that sound weird? Like, that doesn't sound like a particularly clever thing, right? Let's say I knew Apple was going to go up this year. I somehow just knew that magically. I don't know. And then I take that incredibly valuable piece of information and I sell it to a couple of retail clients. That doesn't sound like a particularly clever way to use that piece of information, does it? Wouldn't I try to make that trade myself, or in a geared way, or using options, or raise a lot of institutional money so I get paid a shit ton to make that call? It doesn't sound like something I would do if I had that wildly valuable information. Now, you speak of market risk, market volatility. There's a traded market for market risk. That sounds like double speak, but there's something called the VIX, which is an index of volatility for the S&P 500. There are others too. And there you can get a sense for what is the expectation of future risk. So, I mean, that's something. It's historically been a better predictor than other things. Meanwhile, some people argue it's a lagging indicator because expected risk goes up and down markets. But anyhow.
By the way, regarding this volatility, given the fact that developed market equities have high valuation and that retail investors have behavioral problems, especially during drawdowns, what do you think about a simple rules-based market timing strategy using the popular 200-day moving average technical indicator? In other words, a time series momentum strategy. This strategy was described in a Faber paper called A Quantitative Approach to Tactical Asset Allocation. And also, Larry Schroder.
But look, let me just stop you there. I mean, the amount of academic papers describing some strategy that's been beautiful in the past is amazing. But let's say it's right. Some 200 moving day average. Let's just say they knew that and they were right. Why would you publish a paper? Just go do it. You'd make 100 times more money, 1,000,000 times more money. I mean, and you start with the premise that markets are overvalued. How do you know? Because the high PEs? Well, maybe. I mean, I don't disagree. I'm just saying you don't know. I don't know. And people shouldn't pay money for people that don't know to give them advice, and don't do it. Take a view on what is the risk of the market, what risk can you afford in your personal life versus what do you hope to make from taking that risk, and then allocate accordingly. Don't do all these other things, because that's fees sneak in and you're implicitly saying that you have a lot of knowledge that you probably don't have.
Yeah, on your YouTube channel, you have posted a video advising people not to overinvest in property. In Romania, Robert Kiyosaki has created a mindset among teenagers to buy dozens of real estate properties on debt because he says cash is trash, savers are losers, and going in debt is how money is made. Investors often see this as a free lunch, because they believe they can pay the mortgage from the positive cash flow resulting from the rent, and if something goes wrong, they can simply sell their homes which have equity and get additional money. Which are the main risks of this or pursuing this strategy besides concentration in the local market?
Well, first of all, I don't know the first thing about that person. That sounds like, wow. That sounds like something that people, on the face of it, should be very, very, very cautious about following.
One
First of
second.
all, there's no.
Do you know why I'm asking? Romanian home ownership rate is 96%, and there are a lot of people who invest in 10 properties, 5, 10 properties on debt because this is safer. This seems safer for them because they have control, they say, and they have an edge on the market, on the private equity market.
Yeah, I mean, so one of the main reasons I advise people to be careful about the local it is typically it adds a tremendous amount of concentration risk to their portfolio. People typically buy properties where all their other assets are. And it really, really works until it really, really doesn't work. And there's a huge amount of recency where if property markets have gone up the last 10 years, that's all these stories about people who made a lot of money in the property markets, and therefore everyone expects that to continue. And as a result, you get these kind of, you buy properties, you rent it out, you can't lose money, and it's the hedge for this and that. The reality is, it means that everyone fails at the same time for the same reason, and at a time when they can least afford to fail. Right? So imagine a scenario where the local economy goes absolutely to crap. You lose all your money, probably in a geared market, probably the local currency is appreciated. Your loans are the same, by the way, right? That's why people go bankrupt as a result of these things when it happens. And you not only that happened, but now you probably can't get a job because your local economy is crap, right? Now all of a sudden your education is not worth if you have a partner, that partner's job and savings are worth less. So it's a huge correlation risk that people don't think enough about. But while it's been working, it's a bit like some of these, speculative assets. While it's been working, there's always someone willing to sell it to you and explain you, look, I'm driving a Ferrari, look, how can it go wrong? I would strongly, strongly recommend people that they really consider that. But I'm not saying property markets in Romania don't go up or down. I don't have a clue. Now, people that say that, they do. I mean, think about who's selling them all these properties. Yeah.
You know why they're doing it? Because we have the highest gross rental income in Europe. So gross yield, I think it's called, the indicator, like dividend yield.
Sure.
So it's very high.
Yeah, sure.
So they believe that if this is very high, then it means it has a higher chance to deliver a very good compounded annual growth rate. But it doesn't have to, because the price can decline, right? So.
Of course. Listen, I unfortunately have to go, but I hope this was helpful or useful,
Sure.
and that you can use it somehow.
I have one final question regarding this pandemic and coronavirus.
Sure.
I remember that you said, referring to someone's strategic asset allocation, that during the coronavirus pandemic, I disagree that you shouldn't change anything. The world has become a very different place. It has become more risky. Are you in favor of not blindly buying and holding, and perhaps changing your asset allocation by reducing your equity exposure when the market becomes more risky or overvalued, or your personal finance situation changes?
Yes, absolutely. This is not a thing that's written in stone. I mean, your financial situations can very easily change as a result of the pandemic. You could lose your job. Your assets can be less valuable. Your debt could be a much greater fraction of your overall assets. And the one thing you did know was that while you can't predict the direction of the market, you can see that the markets are far more risky. And how you should react to that depends on your personal circumstances. Now, there's traditionally, although it's not great academic research, but there's traditionally a correlation between risk and return. That makes sense, right? You get paid more to take more risk. So if the risk of the markets is up dramatically, it's not unreasonable to assume you make a greater return. Can you afford that risk? That's up to you.
Thank you very much, Mr. Lars Kroijer, for accepting my invitation to participate into this podcast. I think our listeners will appreciate very much. I wish you a very
Thank you.
nice day and all the best. Bye bye.
Thank you. Likewise. All right. Bye bye now.